The CPI coming out hotter than anticipated is going to send shockwaves and ripple effects through all markets, including crypto, the stock market, and commodities. I'm going to unpack exactly what you need to see, the charts that are interdependent and intercorrelated. By the end of this video, you will have a professional level of knowledge to understand how charts move together. We are the only channel on YouTube that teaches this. Make sure that you smash that like button and subscribe. And if you would like the structural levels, you can get a trading view indicator on all of the Tier 1, 2, and 3 charts at ctksmethod.org. Let's run the numbers. We saw in the latest trading session, the inflation rate year-on-year data came out. It was forecast to come in at 2.9%. Actually, it came in at 3.1%. Whenever the market doesn't get what it anticipates, what it has forecasted, there are problems inside the market. The inflation rate month on month actual came in hotter than anticipated. Core inflation rate year-on-year also came in hotter than anticipated. Core inflation rate month-on-month also came in hotter than anticipated. This caused the US 2-year, the US 10-year, and the DXY to all melt up. This is the second month of hotter than expected CPI and core CPI readings. We can see car insurance inflation is currently 20.6%. In the US, transportation inflation nearly 10%, hospital services inflation, you get the idea. Things are really expensive. We also saw increases in the annualized rate of the core CPI. The 3-month went from 3.3% to 4%, and the 6-month annualized rate went from 3.2% to 3.7%. No wonder 2 interest rates cuts in 2024 by the Fed have been priced out of the market. This is a big problem when we look at median household income spent on annual mortgage payments. Look at this ramp up. This is a big problem. What's more is that inflation eats away at real purchasing power. Wages are just not keeping up with inflation, especially when we look at wages and salaries for private workers. What do we see here? Oh, that's decreasing. What about this? Wage and salaries for government workers. Oh, that's increasing. Nice if you work for the government. Real weekly earnings are decreasing for the first time in quite a while, and when they decrease, it's not a good sign. You can see just back here, real weekly earnings have decreased since the pandemic, but they were increasing, but inflation is making its way back, and that's got everybody worried. When we look at Rule 446, it's a doozy. It's so important to understand. All markets are intercorrelated and interdependent. But what the heck does that actually mean? The Forex market is huge. The bond market is huge. The stock market is huge. Crypto is actually really tiny, but they're all intercorrelated and interconnected. They're all part of the same financial system. How can I actually prove this to you? I know, let's go through the charts. What happened in the past trading session as the CPI data came out, you can see that the S&P 500 just collapsed. Now we know that there are certain rules that apply inside financial markets. Markets are always moving, or the price inside any chart is always moving from an SL or a Stanfield level to an SL or a Stanfield level. SLs are formed through the CTKS method, which is the world's most powerful smart money buy and sell level detection system. So let's see how that actually works with the S&P 500. To get this data, we simply turn on the indicator, and what do we notice? It's pretty clear. We can see that the S&P 500 was coming up to a level of structural resistance. It hit that structural resistance just as the CPI figures were made known, and everything came in hotter than anticipated. What this means is the cost of money will be greater for longer. A higher cost of money translates into lower profitability. higher debt servicing repayments. But what did we notice? There was a bit of a negative fresh air gap underneath the S&P 500, and it fell through multiple safety nets, and it's so far been caught around that 49.30 mark. This is doing exactly as we anticipated to do. If price falls, especially through a negative fresh air gap, it's got a lot of negative momentum. It will take a couple, up to 3 or potentially 5 levels, structural levels, for it to start to slow down. But then you've got to think about what the implications are of whatever shifted the market. Inside the masterclass in TM4, we talk about Bitcoin compared to inflation expectations, but we can just as easily talk about the main markets' inflation expectations compared to the main markets. One thing that we can see, and this was a bit of a cause for worry, M1 and M2 money stock were coming up. What does that mean when M1 starts to come up and M2 starts to come up? That means there's more money inside the economic system. If there's more money, that is typically loaned out. Money is created out of thin air, not just by the Fed, but also by banks. This was one of the reasons that I believed the CPI numbers would come in hotter than anticipated, because when we look at the M2 money stock, it did come down, but it based and then it's been going up. This is purely inflationary. Inside the masterclass in LV19, we go through global markets and Fed recessions. Interesting choice of word, Fed recessions. Recessions look like this. We can see clearly we are not in a recession at the current time. In fact, the Nasdaq has been rallying. It's really been going for it. Look at the Japan stock market. It's also been going for it. The Taiwanese market, absolutely. Bitcoin, absolutely. China, unfortunately, is going in the wrong direction. One thing that you'll notice here is the Nasdaq has started to come down. When we look at the S&P 500, that's coming down. That's retracing. The Dow Jones did, and the Russell did. The Russell retraced significantly. Let's look a little bit more broadly across the markets. When we look at the VIX, the VIX has told us something very specific. The VIX has been bottoming out for quite some time. There's a lot of structural support under the VIX at the present time, and it spiked really hard. This put negative price momentum on the major indices. Also, we saw yields just coming up and up and up, as well as DXY strength. That put negative price momentum on bond prices and also gold. If the yields continue to go up, you would expect gold to come down, especially if the DXY continues up as well. As the yields and the dollar spiked up, what happened to silver? Silver spiked down. Now notice this particular action here. I'm going to talk about that in a moment. If you're trading silver, some levels that you'll need to look out for. One is this structural resistance at 22.37. You can see we've got some light structural overhead and just a little bit of support, much stronger support down at the 21.77 and 21.74 mark. To understand the direction of silver and gold, you need to look more specifically at the yields and the DXY. This is not just applicable to Forex and commodities, it's also applicable to crypto. You can see this blue line, this is Bitcoin. When the CPI data came out, the DXY absolutely spiked up. The US02Y, the euro dollar spiked down, and the US 10-year spiked up. What did that do to Bitcoin? And what did it do to silver and gold? You got it. It brought it all down. And of course, if the DXY is going up, we expect such things as the euro dollar and the Aussie dollar to tank. And that's exactly what they did. It is all interconnected. When we look across the major market indices, we see the S&P 500 futures currently in a downtrend, the Nasdaq futures in a downtrend, the Dow in a downtrend. And we look at the Russell 2000, it's specifically very sensitive to risk on and risk off moves. It's a good one to look at the current time. Inside the service, we also cover off the pound dollar, and you can see the pound dollar was coming up into structural resistance. It had a fresh air gap, a negative fresh air gap below it. Often what we see this a lot actually, if something can't get over structural resistance, can't maintain it and go forward, we see a retracement back to lower structural levels, and that is unfortunately what happened to pound dollar. Looking through the Forex currencies gives you a very good understanding of what's going on. You saw the euro dollar just crashing through its structural levels. This is important to understand. These structural levels may all look like they're the same strength. They are not. Structural levels vary in terms of predictive power and strength. I'll show you exactly what I mean by that. When we turn on the indicator from the service, we can see that all of these structural once support levels are now resistance levels. And where has the euro dollar come down into these strong structural support levels? And it's bounced. It's been caught there, and we would anticipate that as well. The Aussie dollar is also considered inside the CTKS method service, and here we're marking up in excess of 19,000 days worth of data. Just like so many other charts, the Aussie dollar came into very strong structural resistance, and unfortunately this negative fresh air gap with combined momentum and rejection of a key level meant that the Aussie dollar was coming down. We can see a lot of weakness here in the Aussie dollar currently. It can take a while to understand interdependence and intercorrelation. As the inflation data came out, we were just coming into structural support on the DXY. And the DXY here is marked up with the world's most powerful smart money buy and sell level detection system for about 21,000 days. You can see it just shot up. This particular area is very strong in terms of structural resistance. You can see the DXY, the US dollar currency index, is now struggling with this area. This is one part of the issue, and this is also a reason why the futures on the major market indices are coming up, because the DXY is getting rejected from these structural resistance areas. But we can't say, all done. We need to look at the yields. The US 10-year is a very important yield to look at. You can think about this as like mortgage rates, and look at this big candle up to very heavy structural resistance. But what we've seen here is not what we want to see. Remember that the DXY came into structural resistance and said, "Ay caramba, I'm getting out of here." But that's not what's happened to the US 10-year yield. It's grinding through it and seeking to confirm it as support. If it does so and the US 2-year yield follows, there's going to be more negative price momentum across all markets. Therefore, we need to look at the US 2-year yield, and these structural levels have been built out with the world's most powerful smart money buy and sell level detection system in excess of 13,000 days. As the CPI data came out, the inflation data, what did the US 2-year yield do? It just had a positive fresh air gap above it and so much momentum. It piked through two areas of structural resistance and got caught by the third one. What did it do then? It came back and reconfirmed as support that lower structural level. Instead of doing what the DXY is doing, which is basically retracing from there, this one is coming through and seeking to confirm support above that structural resistance level. This is not good for the markets, and it's a reason that I called out the fact that Bitcoin could decrease in price. I'll talk about how you can deal with this negative price momentum if it eventuates, because it's not a pre-drawn conclusion. It is possible for the yields to just start decaying down, but it's not probable. We need to keep our eyes open and track associated charts. The yields are very connected with commodities, and we can see what gold did. When the CPI inflation data came out, wow, it just plummeted. When gold plummets like this, it gives us an insight into what yields in the DXY are doing. When it's come down, what has it actually done? It's just hovering around this area. I'm going to zoom in here and give you a better insight. Because what we need to do is to analyze the SLs or the Stanfield levels, and gold has been marked up nearly 70,000 days worth of data. Just zooming in to that area on gold, we need to pop on the service indicator to understand what the structure is inside gold. We can see at that 1990 level, if that level doesn't hold, the yields are going up, and in all likelihood the DXY as well. If that happens, expect negative price momentum across Bitcoin, across crypto, the stock markets, gold, and other commodities. But if we see this 1995 level getting taken out and a recovery above that, expect the opposite play. This is why you need to look at a lot of charts, not just the one that you're putting money into. Let's have a look at Bitcoin, and we can see Bitcoin has been doing really well. But what happened when the inflation data came out? It just tanked Bitcoin back. We've seen a retracement, but you know what happens inside markets is very yield and dollar dependent. That's why looking at the currencies is critical to your success. The CPI definitely has a ripple effect across markets, and you can see it here. Many people were very bullish on Bitcoin, and no wonder, there's so many good things to be bullish on Bitcoin about. But the problem is, Bitcoin is not a solitary, isolated, non-correlated asset. A lot of people think it is, but it's just a component of the financial system, like gold, silver, stocks, commodities. It doesn't matter. They're all part and parcel of the one big bucket. I'd like to thank everybody for their fantastic questions. A lot of people reached out and said, Ken, you talked about investing and trading in the last video. Excuse me for my drawing, but the concept, investing is very different to trading. In investing, you're taking up a position and you're hodling it, holding on for dear life, no matter what happens. But you want to add to that position in the right times. When are those right times? In the video yesterday, I explained that if you are buying dollar cost averaging on the way down, that is the best thing that you can possibly do. When you're buying $1 for 80 cents or 90 cents, that is significant if you keep on doing that. That's why having an investment portfolio as well as a trading portfolio is important. It's completely your call what you make as a percentage of your investing portfolio as opposed to your trading portfolio. Your trading portfolio could be rather large and your investing portfolio could be small, or it could be the absolute other way around, or they could be equal. It's up to you and up to your risk management. But one thing is very certain, we are in a bull run with Bitcoin. The markets look really good and they should extend gains up until mid-2025. The question becomes, what are the key levels on Bitcoin? Let's pop on the indicator, and you can get this indicator from ctksmethod.org. One thing that we saw, Bitcoin rallied up to structural resistance around that 5,300 mark, and then it backed off, tried again, didn't get it, backed off, tried again, didn't get it, backed off, and then sort of kind of wimped out a bit. Oh, naughty Bitcoin, don't be wimpy, be strong. And what happened? Bitcoin was detecting the weakness in the inflation data, and this is why Bitcoin is so valuable. It is brilliant at detecting risk on and risk off. Remember what's happening inside Bitcoin at the moment. This is primarily due to the DXY backing off structural resistance. What you will do when you do your cheat sheet and you understand the intercorrelations and the interconnections between the tier 1 charts, the tier 2 charts, the tier 3 charts as well, you will see that when you look at a specific chart, you're no longer looking at that chart. You're looking at all the tier 1, 2, and 3 together. To do so makes you a professional trader and investor. Of course, when Bitcoin manages to get through this approximate 5,500 mark, it still has this 51,000 to deal with, and that's reasonably stronger structural resistance than these levels. So please bear that in mind. With your investing portfolio, I suggest whenever the price goes negative, especially deeply negative and capitulates, that's the ideal time to get in. If you're buying on the green, you're doing what retail has been told to do by the institutions. And the institutions, by the way, they're not your friends. The institutions want liquidity. They push the market up only to push the market down. And this happens all the time. This is normal. To trade with the institutions, you buy and accumulate as price is coming down, especially in your investment portfolio. And then you set your targeted rate of return. If you're trading, the targeted rate of return is typically structural levels above price. If you're investing, it's specifically a target that you feel comfortable with. The two are actually very different from each other. We also know that no alt can escape Bitcoin's gravity. If Bitcoin is going up, what is BNB, Binance Coin, doing? Yeah, it's going up. What about Solana? Yep, going up. XRP, going up. Cardano, going up. ADA. What about AVAX? Yep. What about Chainlink? Of course. Now, if Bitcoin comes down, what would Ethereum be doing? Yes, it's coming down. What about Solana? Yep, it's coming down. What about ADA? What about XRP? Yes. What about BNB? It's coming down. And you can often detect weakness in Bitcoin by weakness in the alts. This is a fantastic methodology to use to see where Bitcoin could be going. You'll get to a point where you look at Bitcoin and the alts and say, I know how the Aussie dollar, the US 10-year, the US 2-year, junk bonds, oil, commodities are going because you have that. The Tier 1 charts are the engine of financial markets globally. They are these ones. When you look at the Tier 1, Tier 2 and Tier 3 all together, you start to see patterns that you can't unsee. One thing to take a lot of attention and note too, if the US 10-year, the US 2-year and the DXY continue to go up and we see positive momentum in the VIX continuing, that's going to put a lot of negative momentum across the major indices, major stocks, cryptos, everything, especially gold and silver, and of course Bitcoin as well. We can have market-specific events which can disalign things, but not for too long. The way to think about it is like this. If interest rates go up, as indicated by the 10-year and the 2-year, say mortgage rates and savings rates, if they're going up and the DXY is going up to reflect that, what's going to happen to mortgage interest rates? Of course, they're going up. What happens then? If mortgage rates are coming up, is there more or less disposable income inside the economic system to put into things like the ETFs for the S&P 500 or NASDAQ, or to invest directly in Apple, Tesla, Bitcoin, gold, or silver? There's less. Because we know the structural levels, we knew that Bitcoin was coming into structural resistance, the S&P 500 and a myriad of other things. We also saw that there was a lot of structural support inside the DXY, but not only the DXY, the VIX was just consolidating for quite some time. We definitely would have expected a pump up on the VIX, and the VIX is very spiky and it's likely to pump again. Because we do our three-dimensional risk management parts, we know the US 2-year and 10-year are way above their normalized price path. That strength typically translates into more strength inside the month. And as a result of that, keep your eyes on your emails if you're in the service. The DXY and the US 10-year as well as MicroStrategy upper boundaries have been adjusted inside the service. Upwards, that is.